Hi, I'm Peter Rose, founder of Longwood Currency Trading. How to swing for the Forex fence. That's what we're going to talk about today. Something that I've lost hundreds of thousands of dollars doing. When I get it right, I can make a lot of money. But you have to get it right. You can't get it wrong, because when you get it wrong, and I'll explain how that process works in a minute, but when you get it wrong, it costs everything. Hopefully sometimes not everything, but the issue with a Forex trading as a zero-sum game is that for every win that you make, someone else is losing that proportionate amount. There's no analog, I lose a little bit and you win a lot, but no, it's zero-sum. Somebody wins, somebody loses. In Forex, the retail trading statistics, as I'm sure you're aware, is that 90% of the traders fail. Now, that could be taking into consideration people who fail multiple times as well, but the percentage of failure rate is at least 85% anyway, of just getting started and failing. So the odds are not very well in our favor. Well, let's say it is the 90%. Well, what does that tell you? Well, 10% of the traders are making that 90% of the money. It's zero sum. You're not losing anything to heat radiation or anything like that that we talk about in physics. It's a one-for-one exchange. I win, you lose. 9 of you lose. I win 9x on whatever it is I'm doing. So when do you do that? And how do you do that? In a fast track course that I have, I don't really teach swinging for the fence because that's not the object of fast track. The object of fast track is to replace your job income. In a 6-week period of time, learn the skills and techniques that are necessary in order for you to move your trading forward to the point where you can replace your job income on a yearly basis. You're not going to do that with a $10,000 account, but when you have a sufficiently sized bank, you can replace your job income. Also, if you have a sufficiently sized bank and you swing for the fence and you get it wrong, where's your income for next year coming from? Because if you lose 50% of your account, it takes 100% return on your remaining balance just to get back to even. So the caveat to swinging for the fence, in other words, really, you don't just yahoo, kick the horse and go. It's a more planned out version of that. The race car driver, when he's going into the last lap, does not just slam on to the accelerator. There's a plan, there's a process, and there's risk management involved all that time. Because even a subtle nudge or misstep in zigzagging and taking just that little amount of time off of your race to the final flag could be critical. When you are swinging for the fence, when you're heading for the goal line, you have to have absolute risk management, even stronger than anything that you would do prior to that. When you are looking at a swing for the fence event, you're looking for asymmetric returns, 2x, 4x return. Can you get that kind of money? Well, not doing it in the normal trading methodology. In the fast track course, I teach the seeds for how you would do that, but I don't really go into the details of it because I don't want the focus in fast track to get dissuaded from the goal, which is to replace your job income. Once you replace your job income or at least know that you're going to be able to do that through consistency in your metrics. I mean, you don't have to trade for 5 years before you try an asymmetrical trade. But the goal of Fast Track is to have the student have the confidence in the metrics that they've developed and the underlying information that I've provided and the consulting that I provide that says this is a good solid plan. Here's my trading plan. It's comprised of the 3 major components that a trading plan should have. I have rules. Maybe your rules are going to be different. We discussed that than solving the problems the way that I do it. I teach my life cycle of a currency position, which is the 3 phases or problems that you face in currency trading of entry analysis, position management, and exit methodology. And each one of those problems has a rule to solve it, and I teach that, and then we work with you because that particular structure is applicable for all kinds of trading, whether you're going to scalp or you're going to do an asymmetrical trade or whatever. It's just that it's geared, the presentation, the input that we're putting into those rules is geared so that you are consistently profitable in your trading, such that you're unafraid to dump more wood on the fire. You get a bigger fire by putting more wood on, right? So you have sufficient funds in your bank where the amount of money that you want to make in relationship to your income, let's say you're making $60,000 a year. Geez, wouldn't $20,000 against that 60, wouldn't that be a great start to replacing your job income? And so I work with the student in the last couple of weeks of the Fast Track program to try to work through the math of what you're going to need based on the trading metrics that you've been able to develop in those 6 weeks as to, well, what is a reasonable expectation for how you can trade in a symmetrical manner in order to replace your job income. You don't want to try to do asymmetrical trading to replace your job income. That's counter risk management, but that's what you all are doing. Okay, that's why you're not successful, is because you're taking too much risk when you shouldn't be, not because maybe of your ability, but because of your bank size and what your end goals are. If you're just out there trying to make a ton of money, then you can asymmetric trade every trade that you make. And Fast Track will show you how to do that. It's just that you accelerate certain things that you're doing. You have to do an awful lot of trading in order to be very confident in your trading metrics so you can take that next step. And maybe you take the Advanced Solutions course as well. But in any event, the preparatory work to asymmetrical trading is not to start out learning how to do asymmetrical trading, because at some point when you're doing that, you'll get it wrong and you'll lose your account. And so the whole process here is swinging for the fence as an asymmetrical trade. When do you do that and how do you do that? When you are getting the return, your expected return against risk from the bank size that you have, and you've proved that out, and you have full confidence in that, such that if you take a 20 or 30 pip loss, which might be 3 times bigger than your normal loss, or to take an 8% loss against your bank, that's out of the norm of what you're doing. But last month I had a 7% loss and a 3% loss in the same month. And I was able to jiggle things around and come back. So I was like, I don't know, 0.5% up or 0.3% up for the month. I was up, but man, lost a lot of money getting there. And I was trying to do asymmetrical trades too much. That was my problem. So I'm speaking from some area of expertise and knowledge on this. Here's the condition that you want to have before you take an asymmetrical risk. You need to have enough money in your account where you're making more than your current expected return against your bank. You want to be sure that you are making $4,000 a year, $4,000 or $5,000 a year net off of your trading, and you're adding that back in each time to the bank. So when you are trading, to make that $4,000 or $5,000 net at the end of the year, what size bank do you need to have? Oh, I don't know. We could do you could say 20% against what's $20,000 or, what size bank do you need at a 20% return or a 40% return? I mean, I can't tell. I don't know what your return rate is. You're probably safe at a 20% or a 30 or 40% return. You should be able to get those kinds of returns, because if you're not getting at least a 20% return against your bank on a continuing basis, you shouldn't be trading currencies. To drop down a level of risk and do real estate, or fix up cars and flip them, or something like that. And if you find that you don't have any ability for trading, then go down and invest in mutual funds in the stock market, which I think is just crazy to try to do that, because there's too much unknown. If you find that you're not cut out for the trading and you don't really want to take much risk, then you go into a no-load index fund on the S&P, for example, which is anywhere from, depending on who you listen to, 8 to 10% a year. Well, maybe over the last 8 years, you've got 8%, 10 or 11 or 12% return on the S&P. But during the financial meltdown, the S&P lost 57% of its value. So if you're in the S&P and you lost 57% because you're all in the S&P, you have to balance that off with some T-bills in the background so that you've got some cushioning going on there. In looking at an opportunity to swing for the fence, you must be exceeding on a projected annual basis more than what your projected annual basis return is. I want $5,000. I want to end up at the end of the year with $5,000, regardless of whatever size bank it is that you have or whatever percent return against that bank is. It doesn't make any difference, but you are in a position where you know that with the size of bank that you have, you can make $5,000 a year. But as you're going along, you're really on track for making $8,000. So you're doing much better. So that differential between the $5,000 and the $8,000 is $3,000. That's the amount of money that you can afford to risk on an asymmetrical bet, because you're going to try to take the whatever size bank that you have, and your risk is $3,000, which could be 10% of your bank or whatever it is. But you've got $3,000 that you can risk. But you're going to put your whole bank in there at risk. It's just that you're going to stop and get out when you've lost $3,000. Are you with me? Okay. So now you see that opportunity for an asymmetrical trade. Oh, Peter, well, what is that? Well, that's part of the course in learning what represents your thought that you're going to do 5x better than what you're already doing. Because if you were already doing the best that you can do, why would you expect a 5x return if you can't determine that? See, it's a process. Learning when you have an opportunity for an asymmetrical risk is something that you either know or you got to learn from a course. You got to take a course and learn how to do that, because it isn't just 30 words or less. This is asymmetrical risk opportunity. So I'm assuming that you know what you're doing and that you can differentiate between your normal trading, what you might call a setup. I don't call that a setup. I call it meeting the conditions of your entry analysis and surviving the conditions of your position management. By the way, you are never determining that you have an asymmetrical trade basis during the entry analysis phase of your trading. The decision for that comes when you're managing an already successful position. That's why these things don't come around that often. But when you notice the opportunity that you have an asymmetrical opportunity, well, then you go all in. Well, Peter, but I'm already going all in. Yeah, if you're following the beginner rules of trading, you're all in with whatever amount of money that you have. If you are an advanced trader, which is the only kind of trader that should be doing asymmetrical risk, then you are trading multiple lot positions. And I'm not talking about 3 lots or 5 lots or anything like that. If you're trying an asymmetrical trade on a 1 or a 3 or a 5 lot position, you're trading for the money instead of by the rules, and that'll get you in deep trouble. You have to be trading 8 to 10 lots at least before you even try for an asymmetrical trade, because you're going to be, when you're trading that big of a lot size, you're staging into your positions, so you haven't got all of your bank in. You don't trade with your whole bank in starting. You trade with a small portion of that, so your risk is less when you lose, but your gain is greater if it's successful because you're staging in and moving forward. You can't do this. I've talked with a lot of people and worked with a lot of people, and they always want to get to, how do I trade multiple lots? Or I'm going to trade, I've got a 1 full lot capability positions. I'll trade 10 minis and I'll break that up into 3 minis in. And no. You don't, that's not, you're not trading then. You're learning how to trade. If you're not trading a full lot position, then you're not going to be able to get even a 20% return on your bank. You might have the characteristics of that on a $1,000 account. If you're trading with less than $1,000, you're not trading. You're fucking around and gambling. You get $200 or $300 in your account, you're not a trader. That's not trading. Now, you see really good traders taking $200 accounts to $1,000 or whatever, but you're not a really good trader. You don't have the experience to do that. So if you're trading with $200, you're using a different form of risk management and a different form of trading than you would if you were trading 10 lots. But the object is to get to 10 lots, right? I mean, that's why I don't work with beginners, because you don't understand the full risk management of trading, of any kind of trading, right? So I work with folks that have traded for a while, maybe traded multiple lots, haven't been successful. They get it. They understand. Then when I can lay the plan out for them, they go, oh, I wasn't doing that, and I was doing this here, but not here. And you're asking me to do it here. Okay, I see that. And then we work together on taking what you know and moving that forward based on a process instead of just throwing shit against the wall. And so when you are doing an asymmetrical trade, you are now trading with more lots than you had originally traded at. You're compounding into those adds, and you're increasing the amount of leverage that you have. That's swinging for the fence. You're putting it all on the line. But as soon as you add that increased leverage to the trade, now you're gonna, if that trade takes a 10 or 12 pip reversal, you're gonna lose your $3,000. If you are trading all in, all out, you don't have enough lots to be staging, can you do an asymmetrical trade? Yeah, you can. It's a little more sophisticated than doing it when you have a lot of lots that you can trade, okay? It's not something that you want to think about in terms of a swing for the fence event in the true sense of the term. If you're trading a 1 full lot or 2 or 3 full lots, you can still swing for the fence, but you're not able to do it under the right risk management. So what other criteria could I offer you in order to do asymmetric trades? Let's say you start out with $10,000 in your account, and you build that to, let's say you make $10,000. Let's say you've doubled your account. So you get $20,000. You're trading a 2-lot position, and you're all in, all out. Okay. So now you end up in a situation where you say, this is really going to go for me. Well, you don't have any more money that you can put into it. You could up your leverage a little bit so that you could add more lots. So you could go from trading at 10-to-1, which is how we build our metrics and how we build consistency and good risk management, and you might go to 50 or 100-to-1. If you're in the U.S., I think 50-to-1 is the most that they'll let you trade. But then if you're carrying all those lots, the U.S. has 5% of the total cash value of the position. So if you're trading 5 lots on a 1-lot capability, you better have 5 times whatever the margin level is, which it kind of defeats the purpose. It's very difficult to do this if you're in the U.S., and that's why I think a lot of people fail so miserably that aren't trading in the U.S. that have those protections built in for you, that you're out and trading somewhere out of Bulgaria or something, some broker that's giving you 500-to-1 leverage and you're using it, but you're not experienced to use it the right way. It's no wonder that you fail. Yeah, you get away with that on $200 accounts because you wipe them out and you reload the 200, and all of a sudden you get $5,000 there, and you think you're a hero, and they take the $5,000 to $25,000, and you're just ripping along, and all of a sudden you lose $40,000. Gone. You've lost everything. So the asymmetrical trade is a bad thing to do if you're not properly capitalized for it or have the background. If you're worth a lot of money, then you know you could reload the account. Okay, so risk your account. If you're trading a 3-lot position and you know, let's say you've got $30,000 in there, you're trading 3 full lots, and you see that there's an asymmetrical position. You've been trading the 3-lot position, the $30,000. Okay, but you're rich and you have another $30,000. So if you lose that 30, you can go in and replace it. Then you can risk the $30,000. In other words, you could take a 200 pip, 300 pip, 400 pip retracement because it's asymmetrical. It's going to come back on you significantly before it goes asymmetric. I'm looking at a situation now where you could have been on basically I think it's about a 450 pip move. But in the process of moving down 450 pips, there have been 200 pip retracements. You have to know your currency pair. So what's your risk of ruin? You're willing to risk $30,000 because you can replace that 30. You may not even ever get to the point where it goes that low. It may hit that range bound where the price then continues on. You got to make that 200 pips up, and then it goes on, and it makes the additional 150 pips or something that was asymmetrical to the 10 or 20 pips that you normally make on a daily basis. You're going to make 100. That's asymmetrical. It's a 10x. You can do that as long as you're willing to risk your account. How much of the account should you be willing to risk? My rule of thumb is, in getting back to the $20,000 bank level, you started with 10 and now you've got 20. You've got 10,000 to risk. You never want to lose more than what you put in. As long as that's a basic rule for you, you can do anything you want. Once you are certain that you're consistent, that your metrics are valid, that your trading is good, and you don't do stupid shit. Because if you lose 50% of what you put in, you got to make 100% back just to get even with what you put in. So you never want to lose your starting capital. If you make $1 million on top of the 30,000 that you started with, that's okay. You can lose $970,000, but you didn't lose your 30 that you started with. That's asymmetrical trading. And it's the only way you can really think about it. Unless, like I said, you've got a lot of money on the side that you're going to want to put in to do it. But if you're trading with that small of account where it's easy to replace that amount of money, you may not be trading with correct risk management. Because if you're not trading at a level where if you lost it all, you couldn't replace that amount of money, then you don't have enough fear. And fear is important. Peter Rose, Longwood Currency Trading. Have a great day and have a great trading.